Good afternoon, everyone. I'm Mark Elsweig, Mark Elsweig Company. I've been for the past 40 years working with advisors around evaluating transition opportunities and figuring out monetization and succession planning strategies. And we work all over the United States with advisors at both wirehouse and independent firms. So, the role of a financial advisor has changed radically in the time that I've been in the business. When I first started out, advisors were promoting themselves as, stock pickers who could beat the market. And that's why clients should sign up with them. And then with the rise of managed money, then they became, the consummate asset allocators, the people who could really figure out your asset mix. But I think, one thing that's happened just in recent years, there's been a growing recognition that a financial advisor has to be somebody who does more than investments, someone who really understands a client's life goals and helps them attain those life goals. And that's the kind of thing we're going to be talking about today. So today we have Meir Statman with us. He's really a world recognized behavioral finance expert. He's been in the field for a lot of years, many years, decades. And his work, first of all, is in published in numerous academic journals. He's also been on the advisory board of many journals. I looked up his bio and he has the awards are too numerous for me to memorize, frankly, but I'll give you just a couple. He was got an award 3 times from IMCA, 3 times from Graham and Dodd. He also got an award as a pioneer, as an industry pioneer. So he has many, many accolades, and he's actually the perfect person to really address the topic of how is the advisor role changing? What are clients looking for? And he's recently written a book called A Wealth of Being. And one of the central ideas in the book is that advisors need to move from being just investment people to being people who can help clients live more meaningful, purposeful lives and thereby achieve a higher sense of well-being. And that's what clients are looking for in an advisor. So what we're going to do is I'm going to just chat with our guests for maybe 20, 25 minutes. Then I'll open the floor up to your questions. And then the next couple of days, I'll get out a video to everyone who registered for the webinar. So, Dr. Statman, thank you for being here, and I'm very eager to get underway and to jump into our topic.
Well, thank you, Mark, and everyone who is on the line. I'm delighted to speak with you.
Great. I guess where I wanted to start is, I mean, you've been in the behavioral finance, discipline for years. Even when it wasn't that well known as it is today. And what were some of the things you recently written this book, A Wealth of Well-Being, and I wonder if you could just tell us a little bit about what made you decide that now is a good time to write a book like that.
So this book really and my work evolved over many decades. So let me give you a sense of it. So I graduated from the Hebrew University in economics and statistics and finance, and it was all about rational people. And even though the psychology building was right next to the economics building, and I went there to participate in experiments and earn some pocket money, that was not part of my education. No one of my teachers mentioned it, but I was always interested in human behavior. I can do the math, but I like people. And so
Mhm.
when you put theory next to real life, you find gaps and you wonder why they exist and what can close them. And here's a quick story that is, I came to New York City in 1973 in the fall.
Mhm.
Uh, then came the energy crisis, the boycott, long lines at gas stations. And Con Edison, the utility company of New York, had to suspend its dividend. And the shareholder meeting that followed that was really raucous. And people, I got a transcript and I remember an article in the New York Times about it, uh, where people had to be restrained from going to the stage and strangling the chairman of the board. Uh, so so I was thinking, theory says that people shouldn't care about dividends. If you don't get a dividend, you create a homemade dividend by selling a few shares. So why didn't they do that? Why is all of that emotion there? And I could not really answer the question, bridge that gap until I came across the work of Kahneman and Tversky and some of the early work of Richard Thaler. We with a colleague, her Sheffrin, we wrote a paper about that, and we were lucky to have a good referee, and so it was published. And so this kind of gives you a sense that I've always looked at myself as a laboratory, and I said, if I feel this way, then it might be others. And so let me see if I can make sense of it more generally. And so this has been a continuous work of mine. What I'm trying to do as an academic is to expand the circle of finance by drawing into it insights, information from psychology, but also things from marketing, for example, that are obvious to anyone in marketing and everyone in just real life. For example, that when we choose a car, we look for utilitarian benefits like gas mileage and safety, but we also look for expressive benefits and emotional benefits. What does it say about me? How does it make me feel? Why is it that it is not the same thing in securities? If you have hedge funds, if you have alternatives and so on, you feel like you are one of the chosen, you are an accredited
Mhm.
investor, blah, blah.
Mhm.
And people are really drawn into it, and God knows advisors know that. And so that really is eventually says what really matters to all of us is living a well-being life, living a life that needs money. Of course, you cannot have a family without money. You cannot have medical care without money. But what you really care about, once you have money as a foundation, is the rest of your portfolio. And I think about life well-being as a portfolio. And so you have marriage, and within that you have family, you have marriage, you have children. Sometimes you have estranged children, disabled children. Sometimes marriage ends up in divorce. There are friends. There is health. There is work. There is education. There is religion. There is society, that is, just think about how the politics of the day make some of us really miserable and some of us pretty just happy, and so on. And so I was trying to make sense of that. And it turns out that there is a lot of literature about it, and sociology and economics, and so on. And there are also many stories that illustrate it. And so what I did in the book was to kind of marry those uh, studies by academics that tend to be dry with stories that bring them to life. Stories about dating, stories about estranged children, disabled children, stories about what religion means to people. and so on. So for me, it is really a natural progression. It is not like yesterday I woke up and I said, hey, there is more to finance than mathematics. And so here I am, and I'm delighted to continue with this kind of work.
Right. So you brought together your own personal experience and insights from a variety of other areas. So one thing I wanted to ask you is one of the central points that you make in the book is that advisors need to move from just being strictly investment people to people who can help promote their clients' well-being. So I'm wondering if you could just elaborate on that a little bit and tell us how an advisor might go about doing that. Because I think people are interested in that, how to do that.
So for many years now, I've used the term financial physicians,
Mm,
and I use the analogy between financial people, advisors, and physicians. Now, um, when you go to a physician, when you have to choose a physician, you look for a person who is at the frontier of knowledge in medicine. Uh, but you also look for somebody who has good bedside manners. You look for somebody who reads between the lines. You look for somebody you can share very embarrassing things about your health and perhaps even family. Uh, that that really, when you think about why it is that people switch um, network, health networks, and switch because they want to be with that physician that they think of as their personal physician. And in all likelihood, that physician does not know more about medicine than any other physician. But you've created a bond. So it is really important, both in terms of serving your clients and also in terms of attracting and retaining clients, because again, everybody knows how to do pie charts and asset allocation, but that emotional link that you can create with a client as an advisor, that is really the precious thing that is going to keep them coming to you and recommending you to their friends and so on, so you can grow your business. That really is what matters. And so what you need to do, it is kind of awkward because on the one hand, your clients come and they expect you to focus on the finances. I mean, you're a financial advisor after all. But underneath that is really the desire to have help with life, with the broader issues. So why is it as it is that you kind of cross that line? It's kind of like a woman for a long time. Maybe she's working in the same office, and now you think about her in romantic terms. How do you make this switch? That is she going to say, "Whoa, we are good friends, but I'm not really interested in anything beyond that," or she is really just happy that you made the first move? And I think that clients are generally happy that you make that first move and begin to speak about their life. And of course, this is not news to you. That is, you are doing that. I'm sure that most, perhaps all of you, are already acting as financial physicians. But I think that there are ways to deepen it, to make it better. So there are tools that are available. I've seen card decks where people talk about values, which values are yours, which are not. I've seen work by Money Quotient that kind of goes to those domains of life well-being. They're just different ways that feel comfortable to different people. as to how to cross that line. One that I think is useful for some is to share stories, not make believe cases, but real stories of real people. I have in my book, in the conclusion, I really repeat a story that appeared in the New York Times, a reporter there who lost her daughter, her older daughter, who was 14, cancer that was really developing a long time and eventually took its toll. What does she do? I mean, I can put myself in her shoes. What do you do? What does she do? Well, she uses just in the portfolios. You have some losers, you have some winners. You take from the winners to supplement the losers. And she says, I have a younger daughter, and she still has to discover the world as is. I cannot just dwell on the daughter that I have now going to miss forever. I'm still in a marriage. I still have my work. And so that is what she does. That is what I do, because our older daughter is disabled by mental illness. And so, but I'm fortunate to have the finances such that I can support her without impinging on my own budget. And we have a younger daughter who loves her older sister and supports her. And so, again, as a portfolio, we are doing very well. Does it sadden me that I have a daughter who is struggling, living with mental illness? Sure. But I find ways to compensate. And the other thing that to keep in mind is that when I share this story with others, the reaction always is first to offer their empathy, second to share a story that is not necessarily about a disabled child. Lots of people are fortunate to have children who are doing just perfectly well, but they will mention something in their life that is not perfect, something among their friends, maybe distant relatives. And what it does, and of course I offer my empathy, and what it does is that it creates a bond between us that moves it from having an acquaintance or a casual friend to being a true friend, and if you have to distinguish casual acquaintances from friends know something about you that is not known to others, things that are kind of private generally. I don't really say, hi, I'm Meir Statman and I have an older daughter who is living with mental illness, but this is what I'm talking about. And so one way, for example, to use the book that is to share it with clients and then have a conversation as to which of those stories resonated with you, which of them reminded you of yourself, which of them are very, very far from you. I tell a pair of stories in the preface about an advisor who, loaned some money for her son for his studies, and they signed a contract that she's going to be reimbursed, is going to be paid back when he graduates. Well, he graduated, but he is broke. He's just at the beginning of his career. And she thought that she's doing him a favor by teaching him financial responsibility and demanding that money. But you can see what it did. She said he doesn't even have money to buy his girlfriend an engagement ring. And then I tell my story where my parents, I was 22 when I was married. My bride was 21. We're still married. And when our parents met for the first time, they excused Nava and me to go for a walk. And they sat down to discuss how much each pair of parents is going to give the kids to get them going on their way, having some of the down payment for an apartment. I think that this can be a topic for conversation. Okay, so you have those pairs of stories. Which of them resonates with you? Which of them seems to be the one that is like you? I talk about cultures, that different cultures. Well, in this case, you already have a culture. I come from Israel, and this is what people still do in Israel. What can we learn and adopt from other cultures that can enhance our life well-being, and so on. So there are really many ways to kind of get this conversation going that goes from finances to life, that deepen those conversations where those conversations are already in place, to learn from other cultures, to speak about domains that perhaps do not naturally come, say issues of education. I've lived in the United States now for more than 50 years. I graduated with a PhD from an Ivy League university, Columbia University. But at that time, there was not that fascination with getting into an Ivy League college that we have now. And I was kind of wondering why. And people have, of course, tried to figure out as well. And one reason, and I'm kind of surrounded by people who immigrated from China and India, and they are very, very keen on having their kids in an Ivy League university. And if you inquire about their culture, in India and in China, it really, really matters if you graduate from a top university or just a middle university and getting a job and going on to a profession. In the United States, it is really good to graduate from a college and you have some advantage and some prestige for yourself if you graduate from an Ivy League university. But you can succeed in many ways, even without college. And so, those parents kind of get to understand that they push their kids less, make them less miserable, because not every kid is ready for that. And so that's what I'm talking about. And I'm talking about kind of going from finances to life. And I will just mention quickly, I'm an advisor to Wealthfront, a robo-advisor. If you're not careful, they're going to eat your lunch. That is, they do pie charts, they do loss realization and all of that. They use artificial intelligence. What they don't do is create that emotional bond with their clients. This really is what distinguishes you from the robo-advisors. And I think that it is really important for you and for your clients that you make that switch from financial advisor to well-being advisor.
Right. So really what you're saying is that what advisors need to do is really have personal discussions with clients to create a bond and then to understand what their goals are and what's important to them so they can help them use their wealth, I guess, to attain what matters to them in life. Is that
Indeed. Indeed. Yeah, because yeah, some people want to be the richest man in the cemetery, as they call them. But most people really want to have life well-being. And it is such a joy when you can support your kids when they are in their 20s and 30s, even before you have fully established your own financial security, and you see them thrive. In our area and many areas, just getting a house, getting an apartment is impossible, even for professionals, unless they have parents who chip in. And so, I've learned from my parents, and I did that for my children. My parents were Holocaust survivors. They did the very best they could for me. I simply have more, and I can support my kids more than they did, not because I love them more than my parents loved me, but because I'm just wealthier than they are by far. So this is the thing. Again, just think about. I think about encounters with physicians and which physicians I stayed with and which I switched away from. And I can see that human bond, that emotional bond is really central.
Right. That makes sense. So the other I guess another question is you've been like an expert in behavioral finance for, quite a long time. And I know that one thing advisors use behavioral finance for is to help their clients not make mistakes that are going to investment mistakes that are going to be bad for their portfolios. So I'm wondering if you might have any thoughts on some of the investment mistakes that even sophisticated investors make, and how what can they do to what can advisors do to help their clients not fall into those traps?
So yeah, I'm also a sophisticated investor, and I still make those mistakes, or I have those same urges. There's a famous opinion of Danny Kahneman, who of course is a lot more prominent by far than me, and he is quoted as saying that knowing is not avoiding. Knowing about cognitive errors is not avoiding. But years ago, I was on a panel that interviewed him, and he just told the story about a conversation that he had with an advisor who he already decided that he's going to leave, and that advisor knew that he is going to leave. And that advisor said, look, you're making really a mistake by leaving me, because I can recommend mutual funds that are going to beat the market and all of that. And what Kahneman did was to go back a year to see which mutual funds that advisor actually recommended. And none of them were on the list that he is mentioning now. So what does it say? Kahneman understands hindsight. He understands that advisor might have forgotten which funds he recommended a year ago. But Kahneman had a record of those funds. And so, one advisor actually gave me a good idea that I'm happy to share, that when they have the first meeting of the year, she and clients, she asked them to make predictions about the coming year, about where the Dow is going to be, about whether Trump is going to get divorced, about there's going to be an earthquake, and so on. And when comes the end of the year and the clients remember all of those forecasts that they made that came true, she takes out the list and she says, look at it, you've been lucky in some, but you have not been lucky in others. Now, with hindsight comes regret. That is one reason people are reluctant to realize losses is because people make a distinction between what is paper losses and real losses or realized losses, and they have a feeling that they do not really kiss the money goodbye until they realize that loss. Hindsight, of course, matters here, because they can see and they can say, why did I invest in that loser? Wasn't it clear that it is going to be a loser? Well, of course it wasn't clear, but regret is a very powerful emotion, and I am susceptible to it as much as anyone, perhaps more than average. And so I engage in particular things. For example, dollar cost averaging. Academics will tell you that it is not rational. If you've decided to invest in the stock market, just do it in a lump sum. Why is it that we do dollar cost averaging? Because we are really afraid of the regret we are going to feel if we put all our money today and then the market goes down the following day. And so, I forgive myself and I forgive my clients, my students, and what I try to do is to find methods that would mitigate regret, like dollar cost averaging. And I can tell you kind of stories about what I do, but the idea is to just kind of smile to yourself. That is whenever I make a transaction, and I don't really trade, but I make transactions, say to take money out for R&D or something like that. And after I do that, I kind of watch the market to see if I was smart in doing it on the day. Of course, it is not a matter of smarts; it's a matter of lucky. So I can go on and talk many of those cognitive errors and emotions. One thing that I want to really emphasize is that and that relates to hindsight, that we tend to think that if something turned out poorly, it must be because you made an error. You made perhaps a cognitive error. It is not. It is more likely to be just a matter of bad luck. And so so many of those cognitive errors kind of have this flavor of one that says, look before you jump. That really says, wait a minute, don't rush. And the other says, the early bird gets the worm. Just jump on it. Sometimes jumping on it turns out to be the right decision or the right outcome, and sometimes not. And so you really have to know, and I'm sure you know, how much luck plays a role in investing, and again have to share it with clients and so on. I can go on and fill.
Right. So it's good to recognize that sometimes it's luck one way or the other.
There's a lot of luck in investment. The reason we diversify is because we don't know the future. And sometimes we end up being surprised. There's something that we thought is going to be there, but it's not going to be a big deal. Turns out to be the big deal.
All right. So let me just open it up to questions because kind of on the half an hour mark now. So let me okay, so here's one. If if I look back 20 years from now and said, gee, my financial advisor really helped me. Any thoughts on what kinds of things I might be talking about? What kinds of things really made an impact?
So there are things in finance that really matter where you have expertise. For example, does it make sense for you to convert money from, say, 401k to Roth? And I'm in the process of doing that. It really is going to save taxes for my children. It helps me with charitable contributions and so on. So it is really important to do the finances, about diversification, about trading or not trading, about which investments to choose. These are all important. But I think that you will also, clients will remember, and I think they would, as I remember about my physicians, how you help them with life. They came to you and they asked you about succession. They have the money. Should they give it with a warm hand or with a cold one? Are we going to wait until we die at 95 and our kids are 65 and then they'll get that money because my parents, they say, did not help me, so why should I help others? If they talk to you about that, maybe you're going to have a conversation along the lines of, not everything that our parents did we have to repeat. Uh, we can learn from that experience. Our kids need help now, so we do. And if in fact you help them, say with down payment on a house, and you can see now that that house that they bought is in fact higher or value, that they are in a profession or they are in a business, that they're your grandkids are lovely, and they really uh, kind of erupt in happiness when they see you. That is going to enhance your life well-being. And so if you helped clients this way, they'll remember that. They will remember the kind of guidance you gave them, even if it is guidance that initially they resisted. Um, but you enlarged their possibilities. You said, here's what they do in this other culture. Why don't you consider it?
Right. So basically, so that's an example of like helping someone make a really good decision that has a big impact on them and their children. So that's a heartwarming example.
It is. Yeah, it
Yeah.
is.
Let me just take one more question. How about here's one. If I want to help enhance my clients' well-being and have those kinds of conversations, what's my next best action? What should I do? What are some of the things that I should start doing now?
So when I think about it, I think about kind of dating. How is it that you ask her out on a date, and you're of course afraid that she's going to say never, or on Tuesdays is exactly when I shampoo my hair. Uh, they So there are many ways of doing it. You can reach out when you are walking together and hold her hand and see if she pulls it away or not. Uh, my sense really is that by sharing stories of your life, it is a wonderful way of creating those emotional bonds. Some of you are kind of, you think of your stuff as being private. I just disclosed to you that I have a disabled daughter, and it is a painful part of my life. But if you find that difficult, this is where I think, biased of course, that my book can help, because you can kind of share it with clients, and there are many, many stories there. And some of them are going to resonate. Some of them are going to resonate in saying, gee, I really cannot understand how that behavior is taking place. And some of them are going to say, this reminds me of myself. So some clients, I tell the story that I heard from a financial advisor about a couple prospects who came, and they said, look, before you start planning for us, you should know that we have a disabled son, and we have to set a fund for him such that he is taken care of long after we are gone. So here it is, a case where prospects, clients come out and say that. But in other cases, you really have to gently probe, uh, and how you do it. One, of course, is disclose some things about your life. But if not, sharing stories of others, these are stories that are collected from a sociologist, from the New York Times, from the Atlantic magazine, and so on. And they're real stories. And so many of them are likely to be ones that touch clients. And once they tell you that this story touched them, and you say, why? Tell me more. they're going to begin telling you some things about their life that you did not know and that they were even reluctant to say. I described a conversation with a financial advisor whose son, had a psychotic break, and he knew about my situation, and he and his wife came over, and we helped them. And now a good many of his clients are people who are members of families where there is mental illness in their family, and they know that advisor really understands them. So you
Right.
don't really have to have that experience yourself to be able to help, but if you show that you understand that experience, um, and know what to do, that really is what is going to bind clients to you.
Right. So sharing stories of either yourself or other people sort of encourages, people to respond, clients to respond in kind and creates that emotional bond that we're really that we're
Indeed.
really looking for here.
Indeed, I can tell you many stories of that kind, of acquaintances that became close friends because I disclosed my pains and they reciprocated with empathy and disclosing their pain. And so just that, without any action, without any change in a portfolio or something like that, just that empathy. It costs you nothing. You just offer something that in fact satisfies you as well, and the life well-being of both of you and your newly made friend is increasing.
Right. So thank you. I'm just going to kind of end it here just in the interest of time, but thank you very much, Meir. I know I got a lot out of it. I'm sure our listeners did too. And thank you very much. Really appreciate it.
Well, thank you. It was a joy to speak with you, and I hope that listeners are going to benefit and reach out to me. I'd be happy to hear stories and experiences, and perhaps if I can, give a hand.
Well,
Thanks very much.
you're very welcome, and I'll put our contact information at the end of the videos
Please do.
when it goes out, which
Yeah,
is great.
I'm sincere. I've learned, you could hear it. I've learned many things from advisors, and I'm always happy to hear and speak with advisors.
Great. Thank you again. Thank you, Mayor. Thank you, everyone.